Let's continue this conversation with Citi U.S. equity strategist Scott Chronert. Scott, you think that things could get better from here for the equity market?
Well, we've been pretty constructive for several months, right? Using a 4,600 year-end target premised on earnings resiliency, which has been an ongoing message of ours. We think that can continue into the first half of 24. I think recession risk is still out there as a looming issue at some point in the middle part of next year. But for now, I think equities are taking their cue from the more positive action in rates of late.
So 4,600, we're just about there. And we had some other firms coming out with 2024 S&P targets around 5,100 or so. I don't know if yours is out yet, but does being right at your target mean that you just kind of sit on your hands, or do you look for opportunities elsewhere to strengthen a portfolio?
Well, I think you have to respect the move that's come, from a 10 to 11% up move in the past month or so on the heels of this rate pullback. And, you get that kind of move in the S&P, you have to expect some digestion. So we're of the view that we, for the most part, muddle through the balance of this year to our target. Now, as you look ahead, though, I think the big call for 24 is going to be one of broadening or not, away from this mega cap growth leadership towards other areas of the market. And we're of the view increasingly that broadening is being set up, but by what should be a more consistent pattern of sector earnings trends up and to the right in a positive direction. So basically, we're looking for a broadening effect to carry the index higher. We're using a 5,000 mid-24 target, have been since the end of July. Feel pretty good about that at this point.
Okay, so when you look at comm services, consumer discretionary, consumer staples, healthcare, industrials, they tell you what?
Well, they tell you different stories. So if you look at the action off of the recent S&P lows, okay, this past month, look at the sectors that responded most aggressively. Well, among them is consumer discretionary. No doubt tech is in there, but you also saw a big lift on real estate. My point here being is that what the market had been discriminating among was the impact of interest rates on longer-term fundamental projections. And so what's happened is that those sectors that were at most risk or in concern of higher rates have felt that snapback effect. So we're looking for that effect to continue. So again, the muddle through to the end of the year call here is going to be really premised on the 10-year holding a 4.5 level, if not a little bit improved from here.
I want to mention Zscaler, the cybersecurity provider. Its results are out. The stock initially moving down about 5%. We'll bring you those results when we've gone through them and are clearer on them. It had hit a 52-week high today, as did rival CrowdStrike. Scott, what's your feeling about tech within all of what you're looking at in the markets and the role of AI both right now and in 24?
So we get a lot of questions about the valuation on the S&P 500. And our answer has been pretty standard for several months now, and that is that don't be overly concerned about the S&P multiple. It's a function of this growth tech cohort that's really outperformed this year. The rest of the market is a more attractive valuation mode. So when we think about the tech setup here, we get it. It's a big part of the S&P. It's very difficult for the S&P in aggregate to move materially higher without tech involvement, if not leadership, okay? So we're looking for that to sustain around this new growth driver via generative AI, supported by a more benign interest rate backdrop from this point. But again, that sets the stage for the rest of the market, we think, to show more signs of broadening out, which ultimately is how you get the index working higher from here.